gotten a lot of great quarters so far this earnings season, to the point where some of these blowouts aren't getting enough attention, or we just yawn about them. Take Meritor, MTOR. It's a company that makes truck parts, specifically drivetrain, braking, and suspension systems. After rocketing higher in 2017, Meritor's stock has been put through the meat grinder last year, even though the company kept delivering excellent numbers. I think investors were terrified of owning anything that seemed remotely connected to the auto industry, even when this is much more of a play on trucks, not cars. When the company reported in November, CEO Jay Craig told anyone who would listen that Meritor was in great shape. We know there's a massive shortage of truckers, and thus a lot of trucking capacity is needed. But even the most bullish of bulls couldn't have predicted the numbers we got earlier this week. On Tuesday, Meritor delivered a monster 20-cent earnings beat off a 59-cent basis, higher than expected revenue, up 15% year-over-year, much higher than anticipated. Best of all, management raised their full-year earnings guidance substantially. That's why the stock jumped almost 10% yesterday, and it's now up more than 20% year-to-date. But even up here, it trades at 6 times earnings. That's too cheap. Let's dig deeper with Jay Craig. He's the president and CEO of Meritor. Get a better sense of the quarter and how his company's doing. Mr. Craig, welcome back to Mad Money.
Great.
Good to see you, sir.
Great to be
Have
back.
a seat. Have a seat,
you.
Jay. All right, Jay, I used to teach how to value stocks at Goldman Sachs a long time ago. But I always said that if there's a company that sells well below the market in terms of its price earnings multiple, but it is growing well beyond what the market is.
Correct.
And it's got a secular growth story, not necessarily cyclical, with some cyclicalities. Okay, it's not really possible that it could be at a certain price. You're at 6 times earnings.
Correct.
It doesn't make sense. And I want to try to explain to people how, but I can't.
Well, I think that message is something we want to make clear. We've grown 20% above our end markets over the last few years. We've grown revenue over $1 billion, 25% in the last 2 to 3 years. And over half of that has just been organic growth, market share gain.
Now, trucking business, different from cars. There's tremendous demand, e-commerce, moving things around. We know from intermodal that there's demand for trucks. You're not an auto company.
We are not. We are entirely a commercial vehicle-focused supplier, leading in our market categories of axles and brakes around the world.
So then I start thinking, okay, well, maybe it's like Wabash National, which complained about labor costs and tariffs. But I didn't see those complaints in any of your quarterly decks or anything.
Yeah, Wabash, great customer of ours,
Right.
and but we've done an excellent job of managing those costs, have a great purchasing team, good contracts that will allow us to pass on our base costs, such as steel, any rising costs there.
Then I start thinking, well, maybe people think you can't make this great precision instruments in America. But
Not true at all. Our largest engineering center is here just outside Detroit, Michigan. Our largest manufacturing facilities are in the southeast of the U.S. and the world.
then you've got a kicker. This is why I mentioned secular growth, because I know there's some secular. Electric vehicle solutions. This is something that you're caring about, you're investing in, right?
We believe we've become one of the leaders in that space so far. So we have a number of programs throughout the globe with every major OE, original equipment manufacturer in the globe, to help them electrify their commercial vehicles.
And you think that's the way to go? I know a lot of the truckers really like diesel power.
Well, I think it's going to happen in certain narrow niches. So think about transit buses here in the metropolitan New York area. I think those will move pretty quickly to fully electric,
Okay.
maybe refuse vehicles.
All right, now, there is an asbestos liability here. To me, it seems like it's contained, but the plaintiffs bar, we've seen them get very aggressive. They went after Johnson & Johnson. They caused the company's stock lost billions of dollars because they targeted J&J. I mean, is that something that maybe is an issue for people?
Well, I think it is something to be concerned about for other companies. We just announced a month ago and then reiterated in this quarter, we've eliminated 70% of our net liabilities in asbestos with a prepackaged bankruptcy of a dormant subsidiary that's received 100% approval from the plaintiffs' bar.
Oh, that's very good. Okay, so maybe maybe I'm missing something. Jay Powell yesterday talked about things that gotten uncertain in the month of December. I was on a Dow DuPont call today. They had a terrible December. Maybe December was bad?
Well, I think December had some discontinuity both in the stock market and in
Right.
some end markets. We even saw truck orders take a little temporary dip back to more normal levels. But I think as you see in January, the economy and industry has come roaring back with confidence.
So what is the narrative that you tell people? I mean, you have a terrific piece it's called Perceptions Impacting Meritor's Valuation. I mean, do you eventually just say, you know what, we're just going to buy back all the company because maybe people won't understand?
Well, we are aggressively investing in us with buybacks. And as you read in our first quarter, we actually bought back 50 million of our shares when we saw that disconnection in the equity markets in December. We jumped in and took advantage of that. But I think there are misconceptions, but understandable. We're a 110-year-old company and have gone underneath a very strong repositioning and restructuring of the company in the last 5 years.
Well, look, all I can tell you, keep doing what you're doing. Eventually, as I said when I was teaching Goldman, it has to work out.
That's what we believe strongly, the board and myself.
It has to. Yeah. All right, thank you so much. That's Jay Craig, the president and CEO of Meritor. Even after a blowout quarter, guys, and up 20% for the year, this stock is crazy cheap. Stick with Cramer. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.